fucking haters, you know. Hey. I'm blind to you, haters. Can't touch me, war instigators. Me say we receive love lately. Ask you how the world a run so. Said I'm blind to you, haters. Can't touch me, rumor creators. Me say we receive love lately. Hey, ask you how the world a run so. When things stop up off, them a smile and a laugh. Them woulda love to see you fall by the wayside. Them all a dig up your past, pray for you don't fall fast. And trigger mode from blast like them nana pride. Blessed love to the youth, them. When they touch them better, feel nothing no way. Send no message to the youth.
Welcome back. We are back. True North, episode 32. We are going to get after it. We're going to have a good time today. We're going to talk about credit markets, and we are going to have some fun. We've got the crew. I'm in a new location. I'm trying to get my stuff figured out here, and here we are. There's the crew. All right, tonight we've got Soleil, myself, Dan Hillary, and Adrian. The crew is back. I'm in a new spot. I've got a virtual digital basement background, so we're back into it. I got made fun of for my NFT the other day or earlier today, which is fun. It's if you're not looking at all of the different technology, I think you're missing something there. So I wear it as a pride of, it's a badge of honor that I had my shitcoin phase. So here we are, and we are going to get into it. So today we are going to talk about MSTR leverage update and a Q3 update. So $14 billion fair value appreciation in Q2. We're going to talk about convertible preferred equity. We're going to do a deep dive and jump into it, have some fun. Theoretical preferred equity ceilings. Soleil's got some good background and information on that. It's something he's been talking about a decent amount. The market landscape and the architecture. Just talk generally about the broad equity market architecture, these different landscapes, different countries, different systems and how they work, and think through it and how the implications for all of these equities. Talk a little bit about the S&P 500 debate. We made a lot of noise about it at the end of Q2, but I don't know if you noticed, it's been exceptionally quiet since then. And I think it will be exceptionally quiet until we, get into August. And if there's any time left over, we'll just shoot the shit and we'll keep going. So thank you to anybody that's here. If this is your first time, the MSTR, or we're just calling it True North now, True North, the investment grade Bitcoin podcast. We're here talking about Bitcoin treasury companies, primarily strategy, and the changing landscape of the equity market with these new companies that are issuing equity, issuing debt, and how they're accretively adding Bitcoin to their balance sheet. So our goal is to educate the market, talk about everything that's going on, talk about what people are talking about on X online, and think through the education of all these different systems and with different backgrounds and different perspectives. So, sometimes it may be a little bit more controversial than others. And sometimes, we will talk about quantum computing for 25 minutes and go down rabbit holes. So we're here to have some fun. All right. Well, with that said, I think it's time to jump into leverage update. What do you guys think?
Yes.
Let's talk leverage.
The whole game these days, capital stack
and leverage. There's a reason we go over this every single week, and it's because it's basically the most important part of a Bitcoin treasury company's balance sheet. So here you can see the leverage. So this is MSTR's financial leverage. And when you think about how a corporation is managing their portfolio, you've got assets, you've got debt, you've got liabilities, and you got to think about these things on different horizons. You got to think about the risks that you may foresee at any point in time. And it's very similar, like managing a Bitcoin treasury is very similar to managing an insurance company balance sheet. And I'm surprised there's not more insurance people here in this landscape, because it's very similar correlations. You've got liabilities on the horizon, and you've got assets that you need to match to those liabilities on the horizon and make some money on the spread in between. And now with the Bitcoin balance sheet, it's just your asset is just much more powerful and your liabilities are much smaller, because you got to take into consideration the volatility of the underlying asset that you hold. So My background has played exceptionally well into this space and understanding the leverage of a balance sheet and managing a whole capital portfolio. So looking at Strategy's balance sheet, which we're focusing on Strategy because it's the largest, right? It's the largest by more than 10x. I think they've got 11 times more Bitcoin held on balance sheet than anybody else. The amount of Bitcoin they held at as of today, 7/9, is 597,325. Bitcoin price, I think, was around 111,000. We are cooking up. We are near all-time highs. Hopefully we can hit one here during our show and stream. That will be fun. We've done that a couple times. And so Strategy is now sitting on $66 billion worth of assets, $8.2 billion worth of debt, $3.4 billion of preferred stock. So if you think about the net capital held on balance sheet, it's about $54 billion, which is a very, very powerful balance sheet, right? You think about $54 billion, it's kind of easy to shirk it off and say it's similar to 54 million. No, $54 billion is so much money. It's $100 million 540 times. It's just so much capital. It's like hard to comprehend. And that capital number can grow exponentially quickly and can start becoming vastly larger, which makes them more powerful into the market. You think about size and scale here, $54 billion, that's like around the 190th largest company by market cap. If you think about just the net capital that they hold on balance sheet is powerful in and of itself. So the leverage ratio, sitting at 17.5% leverage ratio. So the price of Bitcoin, so the credit rating for the balance sheet is 5.7x. So that's the debt coverage multiple. How many assets do you have relative to your debt? So this is, think of the BTC rating, and the BTC price needed for assets to be worth less than the liabilities. So in order for Strategy's assets to be worth less than the debt or the liabilities that they have on the balance sheet, the price of Bitcoin needs to go down to $19,465. I think the probability of that is incredibly low, just given that we're a $2 trillion asset. You're talking about a $2 trillion asset going down to a $200 billion asset. I think that math is right. Maybe $400 billion asset, something like that. So significant drawdown, 82%. Looking on this next column, this pro forma basis, this is subtracting out the $3 billion of debt that they've got currently trading as equity in the market. Effectively, this is the $3 billion of convertible debt that's so far in the money. It's very close to, it's basically trading as if it's equity in the market because it's so deep in the money. There will be a point in time where that debt will be called away and that debt will be cleared off the balance sheet and converted into equity. This is not a dilution moment because that debt that will be converted into equity is likely very fully hedged out via short position. So when that debt is closed out, it's likely that there will be a canceling out of short positions and canceling out of equity, which is kind of a net zero impact on the company valuation. But who knows exactly how that will play out, but I think that's effectively the buyers that have purchased this at the very beginning were convertible debt arbitrageurs, and I think that majority of them are using those tools to manage the balance sheet. Okay, any questions? You guys have anything to add on that? I mean, $66 billion of capital. I mean, we are cooking here. If you look at the beginning of the year, it's $41 billion of capital. And I mean, hell, they've increased their Bitcoin held on balance sheet by 150,000. We might need to go back and see who's closest here. We're halfway through the year, right? What were our guesses at the very beginning?
Yeah, I know. I've been thinking about those guesses for a while.
They're, let's see here. They're here.
They're applicable to the Bitcoin treasury landscape. So I remember in November, we were forward projecting the BTC yield as a function of equity dilution or creative dilution and taking in the Bitcoin on the balance sheet. And I personally expected that the ATM accretive dilution would be able to continue into perpetuity, or at least at just a slightly lower rate throughout the rest of the year. And I was completely wrong about that. And that's something we're seeing in a lot of Bitcoin treasury companies, is this idea that you can continue exponential accretion of Bitcoin per share as market cap continues to expand. And the one thing we've learned from Strategy is that you can't. As the market cap continues to expand, and as it gets larger and larger, and the equity is bigger and bigger, you can't just issue equity and buy Bitcoin and have the same effect on Bitcoin yield and have the market still demand that equity over a long period of time. So you can't just project out historical looking Bitcoin yield forever into the future. with
Yeah,
equity.
there's
makes
like an
sense.
economies of scale thing.
Yeah, base
Base
effect math, whatever you want
economies
to
of
call
scale.
it.
Yeah.
And it makes sense because the ATM is dependent upon the sentiment and the mNAV, right? So sentiment is going to waver, and there's no way to project in the future what sentiment will do. So I think that all kind of aligns mathematically and from a common sense standpoint, at least in my view.
Yeah, and exactly. And ATM, the ability to ATM and do accretive dilution is a function of demand for the equity. And as the equity becomes larger and larger, and the yield has to drop because of the assets being larger on the balance sheet, and the demand for the equity will potentially slow, especially during periods of low sentiment, like Adrian's saying. So there's just a lot of factors and independent variables at play here.
For me, the most important thing is sentiment. I think everything is downstream from sentiment in terms of the price, because that's going to drive most of the multiple. It's all about perception and subjective market psychology, really, with a lot of the demand that comes to the equity.
Well, maybe on some of the smaller, less well known ones, right? And you got to think about everybody that's on X following all this stuff right now. Like all of these seem well known, right? Smarter Web Company, AltBG, MetaPlanet. Go talk to anybody about, like, go walk into your grocery store and ask anybody if they've seen what the price of Smarter Web did today. Like, so nobody's going to get it. But I think on a larger scale, you have more people that are paying attention to this because it has a bigger impact on the other components that are in their portfolio that, like QQQ or any of these other things. I played golf this weekend, and it was funny. The guy I was paired up with, I told him, I talk about Bitcoin a little bit. And he's like, oh, have you heard of this company Strategy? I'm like, yeah, I know it. I know that company.
Yeah, buddy, it made me.
And so, that's the first company that comes to mind, right? It's not any of these other companies. And I think that because of Strategy size and scale, they will continue to be that kind of household name. And they will be the one that everybody knows of. And these other companies will be a little bit smaller. So Adrian, what I'm getting at here is that sentiment, that retail sentiment will probably drive valuation of the smaller ones a lot more than, some of the much bigger ones. People think that, why is the stock going down? It's because a bunch of people are mad on Twitter. No, that's not the reason, right? We're talking about a stock that has billions and billions and billions of dollars that are traded every day. That's not retail. Those are computers. Those are computers that are trading back and forth consistently.
Completely. I completely agree. And the other thing, I think that's really important is this idea that, like, when we got involved in strategy, or when I got involved in strategy in MSTR, I looked at it as a leveraged Bitcoin equity. The key point being that there's leverage in the capital stack. Because strategy at the time wasn't ATMing that much. There was very little ATM. They had a lot of outstanding convertible debt. They had senior secured debt. And what that created was a leveraged balance sheet that created that kind of exposure and leverage exposure to Bitcoin. And now everything is just BTC yield over a short period of time because of equity issuance. So I think people have kind of conflated those two things. And having leverage in the balance sheet is one thing, and then having Bitcoin yield is another thing. And obviously they're kind of similar, but they're also different. And it's interesting to think about.
That's an important clarification. Yeah, right. There's this component of leverage that's important in insurance. And again, a lot of similarities here to Bitcoin treasury companies and insurance companies. There's this concept of it's called combined ratio, right? So if you take premium in the door and you pay out claims throughout the year, and at the end of the year, you get judged on how much loss you have relative to the premium, how much premium you have. And so your loss ratio or combined ratio, let's just say it's 70%. That means 70% of 70 cents on the dollar of every dollar you brought in the door, you had loss, but you've got a 30% profit for the year. Most people would think that looks really good. But if you're a seasoned professional in the insurance industry, you would say you left money on the table. You should have taken on more risk. And because you should have levered your balance sheet more and taken more premium in and taken more leverage on, taken more risk on. So that's kind of a concept of leverage is helpful in some capacity in a competitive marketplace.
Yeah, well, MetaPlanet changed the landscape, right? Well, first, I think it was the 42 plan or the 20, yeah, it was 42 plan for MSTR. because that was a departure from what we had seen in the traditional very low ATM issuance, high convertible debt leverage ratio in the capital stack, covering the convertible debt coupons via actual business free cash flow. That was the structure we had seen prior to the 42 plan. Then the 42 plan came and we saw the equity issuance. We saw obviously it transitioned into fixed income issuance, preferred issuance. And then we got Metaplanet, which was strictly some leverage, mostly equity issuance because of the demand for a Bitcoin exposure in Japan. So now everyone's thinking Bitcoin yield, equity demand. But strategy wasn't like that. It was all about leverage in the capital structure at the beginning. And so I think people are forgetting that that's how this all played out. It's all about leverage. It's all about Bitcoin leverage.
Intelligent leverage, managing your leverage with foresight of volatility. Yeah,
exactly. Yep, exactly. Especially in the case of strategy. And that's the other part people are forgetting. It's like all their debt was covered by their free cash flow from their operating business 9 months ago. 9 months ago. That was not long.
Yeah.
Right. And so now we're talking about press. We're talking about arbing, CAGRs for Bitcoin. 9 months ago, we didn't even know what the Bitcoin, people thought it was going to 1 million in like 5 minutes. So people weren't even talking about CAGR, right? So now we're talking about arbing the CAGRs, preferred stocks. So everything's changed, and it's very interesting to be part of.
Yeah. Landscape is changing. It's evolving for sure. Very fast. We were talking about it today. It's like a year in Bitcoin or crypto is like dog years. It might even be longer than that, right? It's like you go 1 year here, it's like 7 years. Everything happens so fast. It's pretty crazy. Okay, so let's just look at who is closest here. 597,000 minus 446,000. All right, so 150,000 Bitcoin added on the balance sheet in the first 6 months. And let's see where we're at. That was estimates over here. And so when they started, BTC MSTR holdings as of 12/31/24 is 446,000. And basically, we're halfway there. We're if you add 150,000 to what they got right now, if they just did exactly what they did in H1, Dan, I think you might be the closest here.
Yeah,
Dan and Mason.
Somewhere between Dan and Mason.
I don't think we're going to get there.
You don't think we're going to get there?
Well, it's going to piss me off if New York Ross, which gets that, because he's just a commenter. Like
he was just a commenter. He just like threw one out there.
Yeah, he just nails it like right on the nose, and we're all fucked.
Yeah. Well, Dan,
because think about it. We've seen it depends how significant the demand for Strike is, in my opinion. It all comes down to the Strike ATM, because I think strategy knows they can't use the common ATM in the same way they have in the past because of the introduction of other leveraged Bitcoin equities in the market, and because they understand now. So think about this. This is a really important. This is something I've been thinking about a lot. I'm not sure if you guys will think it's correct, but let's say Buffett famously said he'll issue shares when the company's trading above the what he believes to be the fair value of the company, right? He'll sell equity at above the fair value. Well, if now strategy is a Bitcoin refinery and they have these operations that arb the USD premium versus the Bitcoin premium and are issuing preferred equity, then the value of the company can't be one mNAV. It has to be one mNAV plus the value of these operations. So I think it would actually be in strategy's best interest to not sell equity at anything below maybe 2 mNAV or 2.5 or 3, whatever they believe to be the fair value of those Bitcoin treasury operations. So I think they will have to actually slow down the ATM issuance of the common and use the prefs. And the prefs, I think, will still take time to ramp up. And I don't think we'll get to those crazy Bitcoin price targets that I predicted at the beginning of the year.
Well, I've got a couple of perspectives on this or theories. I think you're going to be surprised, Dan. I'm hoping. It's not just hopium. I do think the S&P 500 catalyst can provide some significant energy into the MSTR stock, which could provide significant ability to capitalize via ATM. And you think back to where we were in November, right? And I know we talked about this a little bit earlier, and maybe we disagree on this, but there was a catalyst in November where strategy raised $17 billion in 45 days, right? $17 billion in 45 days. There are two things that happened. You had a presidential election and you had QQQ front running, in my opinion. There was a period of time in mid-October where strategy passed the threshold of $40 billion to be potentially included in QQQ. And it became evident that there was very highly likely that they'd be included in QQQ. So I think we saw front running in pretty much all of November. and they had the instruments in play, the capital plan in play, in order to capitalize on that capital that's coming in the door.
Agree with all those points.
Yeah, thank you, Dan. So, you know, there's two things, right? A lot of people say, oh, it's the presidential election. Well, it's like, yeah, it's the presidential election, but the presidential election doesn't cause $17 billion to come in the door on a single stock, right? I think there was some component of that. I would argue a large portion of that, probably 80%, that was a function of QQQ, this capital that's coming in the door. And
100%.
So I guess the real question is, has S&P 500 already been front run? Like, was it front run back in February of last year when they passed the threshold of, you know, $14 billion to potentially be included, but we knew that the earnings weren't going to be there until they adopted FASB fair value accounting in, you know, 2025? I don't know.
Yeah. And I think it's a function of market fair value, right? Like, I don't know. I just think about the incentives of the people in play, and the thing that's like nerve wracking for me, not nerve wracking, but I'll just be, I'm not a bear here, but I'll think about it. If the mNAV rips to 3 or 4 and we start getting these massive $1 billion, $2 billion, $3 billion, $4 billion weekly ATM sales, I think strategy perfectly capitalized on this new opportunity, which they were able to see in the market that never had happened before. The amount of demand for their stock, the NASDAQ front running, all of that. And they capitalized it and captured the gain in Bitcoin per share. But I don't think that opportunity will present itself in the future because the market is now aware of the implications of such behavior in the short term. So I think it makes it a little difficult moving forward. And they'll have to be more diplomatic with the way they issue that common equity ATM.
Right. Yeah, I mean, who knows, right? It's tricky, right? Every dollar that they bring in the door on MSTR, let's just say there's a ton of energy. If they're doing a TWAP, VWAP sort of situation, and they're able to
TWAP, VWAP,
TWAP, yeah, they just FediWAP the ATM,
Yeah.
the MSTR ATM in there. And if they're in a situation where they have the opportunity to raise, I mean, what, you've got $18 billion left on the ATM here on MSTR. They raised 17 billion in 45 days, and I think over like 25 billion in 100 days, something like that. So if you think of the scale, and if a similar type scenario happens with S&P 500, which could happen, I'm not guaranteeing it's happening. It could happen. There could be a significant amount of capital and energy that's coming into the stock really quickly, and you'd want to capitalize on that because that gives you so much more power to issue more prefs, right? Because that's instant capital held on balance sheet that improves your leverage ratio and improves the credit rating, BTC rating of all the other instruments that you could offer. So instantly, this is what they all of these instruments are so synergistic, right? Like you use the MSTR ATM, it's like, great, now I could go issue more of these because the technical theoretical credit rating should be improving, right? If they're using the MSTR ATM and they're buying Bitcoin, Strife should rocket.
Yes, I completely agree with that wholeheartedly.
Strife should rocket, right? Like, because it's just,
yeah, Strife.
But you can't sell them at Strife. Well,
what do you want to own?
Strike and Stride. All of them. Yeah. The credit ratings on.
You want to own it all. I think you want to own it all. If you're long MSTR, you don't want to. I think a lot of people say like, oh, but all these benefit the common. It's like anything. You can have a great company that's overpriced. You can have a shit company that's underpriced, and you may make money in one scenario, may make money in another. But in this case, I think the prefs are still underpriced relative to where they could go. So I think if you want to be long MSTR, it's really cool to own every part of the capital structure because they all shine in different kind of periods of time.
Completely agree with every bone in my body.
Oh, on the same wavelength here tonight.
Yeah. Adrian Soleil.
Can we talk about this idea of Strife approaching the risk-free rate as prefs convert? Because I think that's like huge for understanding the capital stack and where it will be in the next
Strife
few
or
years.
Strife? Yeah.
Strife.
Let's lead it off. And unless Soleil, Adrian, you guys have anything else to add on that topic here? We're talking leverage. We're talking prefs and the dynamics at play in the rest of H2 2025.
Now we can move on to preferreds.
Yep.
Dope. All right, go ahead. Dan, Soleil, kick us off.
Yeah, let me
Well,
so I did
so
yeah,
like, can we refresh where how the capital stack
yeah,
exists?
do that.
No, will you do
Oh,
that? I need a reminder.
sorry, you want me to refresh what?
How the different layers of the capital stacks, just so everyone remembers.
Oh, sure.
like, how it's stacked.
So, Strife is going to be at the top. They're basically guaranteed to be made whole first, right? And then we got Strike right below them, and at the very bottom, I guess the junk bond version is STRD, and so that's the most risky, and should trade at a lower price, and potentially provide the most, dividend. Anything I missed there that you wanted to cover?
Creates a yield
That's
curve. MSTR, the common stock equity, is the most risky, so it sits at the bottom. So in the event of a liquidation, the whole reason this works is because the way that these are contractually designed is that they add more risk into each instrument. So Strife being the most senior, Strike being the second most senior, Stride being the least senior, and MSTR being at the very bottom. Basically, in the event of a liquidation, MSTR shareholders get money last if there's any money left over. It's just it's theoretical risk.
Yeah, I forgot to mention.
Which is the most.
I forgot to mention the common shareholders at the bottom.
Yep.
No, they don't count. They just don't fair. Yeah.
The converts sit above Strife and Stride, don't they?
Correct. Very top.
Mhm.
Yeah, but we're not doing that anymore.
Yeah, get those out of here.
Yeah. Well, Jeff, do you know the actual? Can they call those early for conversion, but it creates bad blood with the convertible investors, so they're incentivized not to do that, and it's actually disadvantageous to MSTR because there's a provision that essentially converts more shares to the
yeah. It's less advantageous depending on the price of the underlying common stock. So like as the price of the common stock goes further and further out, it gets closer to this, like I guess you'd call it like a parity of like how many shares it should be represented of. So if you call it early, there's just more shares associated with it. And I'm not 100% sure exactly how much energy is being stuck into, trading and arbing MSTR relative to the converts that are deep in the money. I think it's got to be a very low proportion, but I'm not 100% sure.
Yeah, no, that makes sense. But it seems like from everything we've gathered that the converts are on their way out. And that's extremely important for the positioning of Strife. Because Strife to really to take its throne, it needs to be at the very top of the capital stack. And that's extremely important. Because in the prospectus of Strife, sorry, I said Strike, I apologize. I mean Strife. It's a crown jewel. And in the prospectus, no preferred no senior liability or liquidation equity can be issued above Strife without the consensus and vote of the Strife shareholders. That's the only preferred with that clause in its prospectus, which means nothing can be issued senior to Strife other than these convertible term debt instruments. And once those have been taken out of the capital stack, Strife will be, right now, it's roughly, I think, 10x over collateralized. Not quite. It's like 7x over collateralized. If today we're sitting at the top of the capital structure, it would be 66x over collateralized by the Bitcoin on Strategy's balance sheet. And so when we talk about approaching the risk-free rate, this is what we mean. And when any amount of Bitcoin is bought via any other equity capital raise, it will directly benefit the creditworthiness of Strife. So if you think of it as a limit, the limit of Strife or the credit spread of Strife will tighten as it approaches the risk-free rate of the US dollar. And that's ultimately the terminal coupon of Strife is the risk-free rate of the US dollar, if you believe Bitcoin's money good.
That's a super important distinction, that when those convertible bonds roll off, STRF is literally at the top now, and their creditworthiness just goes through the roof.
Through the roof. What's the difference between a 7x over collateralized preferred equity instrument and a 66x over collateralized equity instrument in a highly volatile environment? It's night and day. It's absolutely massive. So.
Huge. Real quick, we got some feedback in the comments, and I got to play a video real quick.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only. Jeff?
There we go. There we go. Just had to get that
Thanks,
in there.
Tim.
This is not financial advice. Thank you, Tim. And I forgot to do that at the very beginning. 30 minutes in, and we'll put it at the beginning in the YouTubes.
Everything before this was financial advice.
I guess so.
Just kidding.
Yeah. No, that was fantastic. Thanks, Dan. You hit the nail on the head, right? The collateralization level of this, the difference between 7x and like 65x over collateralization is vastly different. And I think it might make sense to jump into this this image that I put out on X. What was it, yesterday? And go through this, because I think this is what's happening with all of these instruments, and I think it could be worth going over it. So unless you guys want to take this any other direction.
No, go for it.
No, that's
absolutely good.
I think we should hop into it. Someone asked what the risk-free rate was for a perpetual instrument, a perpetuity. It tends to be based off the 3-month T-bill risk-free rate, which is 4.13%. Right now.
So everything in the market is judged relative to that risk-free rate. So you think about the credit spread. So like what's Strife trading at today? It's got to be, it was like 8%, 7%.
Yeah,
8 flat. So Strife's at 8. Then the credit spread is 400 basis points. So it's the relative risk. Like, how risky is this instrument relative to the risk-free rate? And it's still at an 8% risk-free rate is treated as if it's distressed debt. It's like still so far mispriced, and it's got opportunity to continue to grow because of the relative risk relative to the risk-free rate, in my opinion. So, and if we focus on the left-hand side of this image here, then we could kind of go through what's going on with the prefs, and this applies to all of them: STRF, STRK, and STRD. When these instruments were priced by the market at IPO, let's start with STRK, Strike. Strike was priced by the market. Nothing like this had ever come to market before. It was the first of its kind. I think it was priced at either $80 or $85 to par. Par was $100. So that means they're offering $8 per share, which would be 8% at par. But it was priced at $80, meaning it was offering 10% per share, and it was still convertible into common stock equity into the future. So as the market was digesting this, the credit spread when this thing was issued was like 600 basis points. There was nothing else in the market trading like it. You could look at like any of the other preferred stock instruments. You could look at Boeing, you could look at PG&E, which I brought up ad nauseum, and you could look up GE, Apple, Microsoft. You could look up even the crappiest companies you've ever heard of, and Macy's, yeah, JC Penney's, or what, those companies. I don't even know if those companies still exist. Does Macy's even still exist? But
yeah, that trades at about a 250 basis
point credit spread
with senior secured notes above the unsecured debt, which I'm talking about. And that's really important. We should get into it later.
Right. So you think about the relativities here, right? And you're talking about this preferred equity being priced at a 400 credit spread relative to a Macy's senior convert or senior debt. And that means, in my opinion, that this was significantly mispriced. So as the market recognizes what this product is, which takes time, you see this, the price of the convertible, we're going to call this, instead of calling it convertible bond, the price of the preferred equity is going from point A to point B on a pricing curve, because the market is recognizing it's going from distressed to fair value bond-like pricing, like a fair bond pricing with its relative risk being valued correctly or appropriately. Maybe not correctly, appropriately. So that's what we've seen with STRF and STRD, because these IPO'd so low at such a discount, and technically relative to other things were considered distressed. That's why we've seen the price go up drastically in a short period of time, because the market is beginning to recognize that these aren't as risky as they originally thought. And, if you're going to go raise $1 billion of capital and doing these weird new instruments that have never existed, you need to make it attractive in order to do it. So the early capital that came in the door, they were taking on, technically more risk, because these instruments haven't existed before. Maybe it's reputation risk, not just credit risk. And that's that pricing was reflected as such. I don't think that will happen again. I don't think there will be situations where these deals get priced as low as they do, but I could be wrong. Who knows? So what we are seeing here, so if just thinking about Strike being the convertible preferred, so again, ignore this convertible bond, just call this convertible preferred price. We're going from point A to point B. In my opinion, I think we're still in this this technical distressed zone. So there's still opportunity for the price of Strike to increase upwards relative to its credit risk. So it starts trading a little bit more like a bond. Now, when you look at this image in total here, you see this dotted line up and to the right. This is equity. Just if you assume the equity share price is going this direction and it's going in a linear fashion, this red line is how the preferred equity would price relative to the underlying price of the equity. So what you could see in this situation here is that even if the price of MSTR is going up from, let's just say right here, 0.0 to this line over here in the distressed column, you'll see that the equity moves up linearly, but the convertible bond is moving up kind of exponentially because the market is re-rating this. Now, there may be a point in time where once the relative price of STRK, from a risk perspective, is start to reflect a more accurate risk assessment, STRK may underperform the underlying common stock equity. And you can see that here with the red line flatlining a little bit while the equity line is still going up, vertically. Now, will that happen? I'm not 100% sure because nothing has ever been in the market like this before. And I think we could see a situation where instead the price of the convertible preferred looks a little bit more like this. Where's my? You guys see this?
Mm-hmm.
Yeah. So we may see a situation where the price of the underlying STRK moves a little bit differently because it's such a unique instrument, and MSTR is the underlying equity that underlies how this thing is priced. So it may move a little bit more linearly, which, Dan, I think is probably part of your underlying thesis here, that
it's super weird. It's super weird, right? Because there exists an arbitrage between Strike and MSTR at all points in time. And so it's and then you have the ATM working on right now only on one of those instruments. And so there's all kinds of weird pricing discrepancies at every second of the day.
Right. And this is just the Strike instrument, right? If you think about STRF and STRD, again, those are not convertible into underlying common stock equity. So it will only have its relative risk pricing. So it will be priced relative to other credit risk within the market. It won't have it shouldn't have much, if any, correlation to the underlying MSTR price. It should be more of a correlation to how much capital is held on balance sheet, the value of the assets relative to the debt held on balance sheet, and its over collateralization or the BTC rating, and how it compares relative to underlying interest rates. And you've got two components that control pricing with Strike, right? You've got interest rates, what is the interest rate that it's paying, and what is the underlying convertibility. And those both have different weights at different points in time. So as the, if we were to see a situation where, interest rates drop 300 basis points, like President Trump is calling for, the price of all three of these instruments, Strike, Strife, and Stride, should rip up if that actually happens, because the relative risk would get repriced very quickly. So the price would go up, the yields would fall, and this would happen across anywhere in the bond market. If there's a repricing of the underlying risk-free rate, bonds will rip higher, and everything will likely rip higher. Stocks will rip higher, bonds will rip higher, yields will fall, and who knows what kind of world that looks like.
Yeah, and we'll talk about, I did a video on Macy's balance sheet as well, and I'll talk about that later. But for reference, their free cash flow last quarter was actually 38 million. And so in their assets, they only have about 6 billion worth of real estate assets, a portion of which is actually secured by their senior secured instruments. So there are nuances in these different companies. And I think all the points made in the comment are correct in that strategy doesn't have the same amount of free cash flow to cover the debt obligations. So yes, it's a different framework for understanding the risk associated with these instruments, but you have to also understand the perpetuity of the instrument, and the liquidation preference makes it such that strategy in a worst case scenario will have to issue equity to pay the dividend, even if it's trading below par. So that's all part of the kind of prospectus framework at play here.
Bingo. Yeah, it's you got something to add to it, Adrian? You got anything to add here?
No, this all makes sense. I've just been listening to it very intently. I think everything you're saying makes sense.
Yeah, so I was doing a little grok foo with the potential ceilings for these, and we're talking about strike first, which is the most complex one. That one's the one that makes my brain hurt a little bit. But if we take the risk-free rate, at the time I was doing the math, I was using about 4.5%. But if you take the $8 dividend at par and you divide that by 4.5%, you get a ceiling, if we're just going to assume that the risk-free rate is the ceiling, of about 177.78 just for the dividend only. But here's the
Yes.
but here's the weird part. So it's got the perpetual call option, right? At 1,000 from par. And if you go out a couple of years, $1,000 strike call option is going to be about a little over $4,000. And since it's a 10-to-1 conversion, you can add about 10% of that. So basically $4 per share, which only brings us up to
no, isn't that more than
so
that?
We'll get there. But so the option contract is going to be $40 per contract, but since strike is 10-to-1 conversion, you're only going to get $4. So that brings us to 182.41, including the call option. But I'm going to let you guys tell me why that's bearish, and then I'm going to save my bullish pitch for the end.
I feel like it's not bearish.
No?
Well,
It's like
isn't it $400? So it's $4,000 represents a claim over 100 shares of MSTR.
So it'd be 1,000 shares of strike.
It'd be 1,000 shares of strike. Right. Okay, cool. Math.
All right, so here's the weird thing. So the reason why call prices aren't even more expensive than they are is because they have an expiration date. Right. So if you drove a car off the lot, it depreciates. But what if it didn't? What if the price of that car could only ever go up? How much would you pay for it? Infinite.
Right. Yeah.
It wouldn't matter.
Yeah. There is no number. Right.
I could. Yeah. If I could pay $100,000 for the car, and I'm never, I'd just be able to sell it for $100,000 or more in the future. So it's really hard to figure out what the real price of that call option is that never decays. So that's usually the problem with buying a call, is you have to give yourself enough time to be right, but you have forever to be right. So this estimate for how much the call, the call option improves the price of strike is very hard to kind of imagine. And if you look at the Kelly criterion formula, which basically tells a gambler, based on the ratio of the likelihood of winning a bet, like how much you can bet per occurrence to never go broke. If you plug in a bet that you can never lose and only win, Kelly criterion will tell you to put in 100% of your portfolio, like as much money as you can possibly get, which I'm not necessarily recommending anyone to do, but I'm just saying that's what the math says to do. So it's just kind of a weird thing. And I know we've had some conversations offline that we think it's extremely unlikely that the ratio of strike price to strategy price would ever get to the point where it would actually be advantageous to convert. However, if you say that it's a very, very small chance of it happening, but we have infinite time, like no matter how improbable something is, given an infinite time frame, it's inevitable. So like winning that call option is an inevitability at some point. So it's just it's extremely valuable because you can never lose and only win. And it's kind of hard to imagine what kind of premium would be added to Strike's price to pay for that.
Absolutely. I think you said that really well. Well, and then
With
think about
every
the
bone in your body.
convertibility.
Yeah.
Yeah, every bone. But think about the convertibility as it exists, right? If you could convert, so I just add this to this this mental framework. If you can convert Strike to MSTR today, which you can't below $1,000 a share, but you, in theory, you could at $1,000 a share. If you were just to convert your Strike into MSTR right now, you'd have $40 of $41 of MSTR per Strike share, right? That's the 10-to-1 conversion. So you can think about it as an indefinite call option, like Soleil's thinking about it, or you can think about it as just a conversion right, which represents an exact delta percentage relative to MSTR. So it's a 40 delta, a little less than that, 35 delta instrument as it sits now.
Should we talk about why somebody would convert? Because
Let's hear it.
Well, I think it's an interesting conversation, right? Like, why would you convert? Like, why would you convert Strike ever?
Why ever? If it was paying a 0.0000001% coupon, it would be, I think, irrational to convert. It
would be even so. You think that there's no incentive ever to convert?
No, not zero.
Huh?
You'd sell it. You'd sell it.
You'd sell it
on the open market. It would be worth 0.00001% more. Right? If you had,
but what if it's not liquid? Like, why would anybody be buying it?
Because they want MSTR with a conversion preference and a dividend.
Well,
what's MSTR worth? What's the difference? If you had an MSTR share that paid you, if you had MSTR or you had the ability to pay or buy MSTR that paid you 0.01% annually for the next infinity, how much more valuable is that product?
I mean, are dollars good?
Yeah, because I mean, even if it paid 0% dividend, if it was trading at a greater than a 10-to-1, you could simply just, it would be just arbitrage. You just buy as much Strike as you possibly could, and you would just immediately convert. And if it was, if strategy was trading at 1100 and Strike was trading at 10 or 100, you would just buy as much Strike as humanly possible, and you would immediately convert, and you'd just be making 10% as fast as you could do it.
Exactly. So Strike will always trade at a premium to MSTR.
But I feel like you would convert for a few reasons. One, if there's an instrument that's issued more senior to you, right? So something could be issued in between Strike and Strife.
Mm-hmm.
Totally, yeah.
So let's say you get to a situation where you're talking about, Dan, where the yield is 0.001%, and there's another instrument that gets issued more senior to you, and now the conversion premium's higher. Let's just say it's $2,000 a share, or $4,000 a share. What?
Yeah, so
Strike
2.0, like that, right?
You've got one more senior that's trading at, or that's got a conversion of $4,000, but it's back to paying you $8 a yield, $8 per share yield. So you got two options. You can now be less big because you're effectively shifting further out. You're more like equity. You could go shift. You can convert into MSTR and sell, I guess, into and buy into the new instrument that's issued in between potentially.
That's a really good point. But I completely agree with you. You might want to shift into that new instrument. But I disagree with the idea that you would convert into MSTR and sell MSTR, because I think there would still be a market for STRK at that point, and you just sell STRK and buy the new instrument.
Interesting. But if it's let's just say it's what if it says that what if the BTC rating is like 20 on Strike?
On what? That only adds to its value, in my opinion.
It's just like crazy over collateralized, and you're like, okay, well, the risk of this thing is like 0.
Yeah, well, I'd much rather hold the thing with the liquidation preference than the thing with no liquidation.
I guess you got voting rights is another thing.
Oh, voting rights. You brought that up in our chat. And that was
what is that valued at? None of the prefs have voting rights.
That's a reason to convert. I think that's a super valid reason to convert. You want shareholder voting rights.
Yeah,
totally.
And yeah, it's really interesting. I mean, that whole.
But I want liquidation preference, especially now the liquidation preference moves. So before, the liquidation preference was static, so it was fixed at $100. So if the price of Strike traded up to the limit, let's say MSTR is trading at 4,000, Strike would likely be trading at around $4,001. If the liquidation preference is 100, Strike still has slightly more value in that case, but not that much more value than MSTR common, right? Because $3,900 is not protected by the liquidation preference details. But now that the liquidation moves up with the price of Strike, I think it actually adds significantly more value to that security.
Right.
But then again, like if there was a scenario in which this is the other part, if there's a liquidation scenario, MSTR would trade down to 0 or would trade down to NAV. MSTR would trade down to NAV in a liquidation scenario. Then Strike would also trade down to match the arbitrage between the MSTR price and the Strike price, which would lower the liquidation preference. So there could be arguments made that actually the increasing liquidation preference doesn't even matter, because in any scenario which the liquidation preference would help you, the common trades down so low that Strike would follow the decline in MSTR. So liquidation preference would trade down as well. I don't know.
We're starting to get comments. This is sounding like Adrian's talk about quantum entanglement.
I think it's interesting to think of where it could go in a 1 mNAV scenario. Like, what if they had these products when you were buying, Jeff? And specifically, what if they have these products in a 1 mNAV scenario where the free cash flow of the corporation doesn't service the debt?
Say that again.
So what happens in a 1 mNAV scenario for the common equity holders where the free cash flow of the operating business doesn't service the debt, and the debt being the coupon payments of the instruments?
Yeah, right.
They're going to have, in a 1 mNAV equity common scenario, they're going to have to service the debt and preferreds with equity sale, common equity sale, or lower in the capital stack pref equity sale. And that's harmful for BTC yield, but it also makes kind of the value of your senior claim on assets like that much more important. So yeah, it's crazy weird things that happen in those scenarios.
I think it's helpful, right? You got to think about tail scenarios and how this all plays out in all of these instruments, right? Because they would factor into the risk assessment of how this whole thing works. Especially, we're going to see other companies start to issue these things, and it's going to get trickier and trickier, right? Everybody's going to be experts on how these things work. But then Semler's going to issue these, and you're going to see a dozen other companies issue these, and the equation is just getting harder and harder.
So hard. And think about it with something like a Bitcoin treasury with a secured note, right? Like, can you imagine for example, if Strategy's convertible notes were secured, meaning they had a margin call provision that sits senior to Strife? If that were the case, Strife would be worth nothing. Like, Strife wouldn't be worth anything. It wouldn't be worth nothing, but it would be worth very little. So these things, like small nuances, like the secured or unsecured provisions of these convertible notes or senior capital structure, like matters like night and day for how these things will trade.
For me, I tried to
because think about it, like for Inaka's case, right? They have like 750 million with Bitcoin. They have a 250 million secured convertible note that sits senior in the capital structure. Let's say they issued a Strife junior to that senior secured note, and they have a 2x margin call provision on the secured note. If Bitcoin were to drop 60%, the Naka secured holder could call the Bitcoin, the margin call provision, and take the Bitcoin, and the Strife holder would be left with nothing.
Yeah, you've got nothing
in the case of a liquidation scenario. So what's the creditworthiness of that fucking?
Basically, if you have a secured note that sits senior to this, the probability that you issue prefs is like 0 until they're unsecured.
Exactly, and until you wipe that note off your sheet, they'll just yield like 13%.
Yeah. Well, it's gonna probably more, right? Like it probably yield higher than that.
Probably. I mean, it should yield higher than whatever Stride's trading at now. Which
12%.
is like 12.5%.
Yeah, it should be higher than that. Huh. Interesting. Yeah, I mean,
with all these, I try to distill it down to make the decision as simple as possible. And for me, it's 1, I'm getting a dividend. 2, I'm getting some of the upside potential with reduced volatility to the downside. And 3, it sits senior in the capital stack. And 4, theoretically, there's potential for even outperformance at times, as we've seen in the last couple months. So I think that all of the points you're raising are very, very valid, and I've considered them. But when it comes time to pull the trigger on how much strike I'm going to have, I have more confidence in having more strike today than I did when I was buying it when it first rolled out. And I think that's played out well for all of us that have done it. So it's there are too many moving parts to get an accurate read on it. So for me, I try to distill it down to the most likely outcomes when I'm making the decision, and it's worked out well. Strike and strike.
That's what's so fascinating about them, right? They're like outpacing the common.
And it could
a little bit.
It could be,
and it's just a market dislocation.
Yeah,
It's
but
like
it could be
shouldn't
back to
forget.
what I was saying, or rather, is what Saylor creating this economy. What he's doing is he's attracting different players to the strategy ecosystem, and they're going to have entirely different use cases for these offerings. I've been talking to people that said that they don't want to buy MSTR, but they want to buy Strike.
It's waste.
Which I mean, like makes
right.
sense for like 90.
You're 99.9% of people, right? Like you're not gonna.
Yeah. It's the best risk adjusted return.
If you're managing hundreds of millions of dollars, of billions of dollars of capital, and you're just worried about like making sure that your paycheck doesn't disappear, you're not going to get fired if you buy this.
No, exactly. And if you're not 100% in MSTR, it makes sense to buy.
Yeah, absolutely.
And just take the 10% coupon that's attached to the MSTR exposure plus the liquidation
price. Yeah, you're protected. You've got so much downside protection.
Well, if you think about it, let's say that I had $250,000 right now and I want to get into the market, right? Or rather, I have a $250,000 allocation I want to put into the market. And I have to choose between Strike, Strife, Stride, or MSTR. At a very, very simple sense, which one's going to give me the most upside with the least downside? And which one is going to be relatively easier for me to understand? Do I need to understand MSTR to understand Strike? Or do I just need, as an investor, to understand I'm going to get a dividend on it? It's going to be less volatile, but I'm still going to have upside potential. I think for a lot of people, that's all they need to hear. So we're going into a lot of the detail because we've been in this for God knows how long right now, and we're weirdos that like this stuff, right? But for an investor that's looking to allocate capital, that wants exposure to this, that perhaps doesn't understand all the different nuances, I think that's why Strike and Strife have been outperforming. They're getting into the play without needing to fully understand the play.
Yeah. Okay, this company has $66 billion of Bitcoin, and they have $8 billion of debt. So the Bitcoin would need to go to this in order for this to blow up, and you get paid 10%, and Bob's your uncle, and see you later. Like, you're good.
Essentially,
it's a much easier sell. I mean, the really cool part about this compared to the convertible bonds, right? Like the convertible bond market, it's just a bunch of vol junkies that are out arbing convertible bonds, trading in the OTC market relative to the underlying stock, and just playing with data and numbers and computers and shit. Now, like these preferred buyers is a completely different cohort of people, which is so cool because the people that are buying this is solving the retirement issue in America and the world, right? Like these Bitcoin backed instruments could truly save the world and their ability to, like, it could save the retirement problem. Like Social Security, everybody on the screen's never going to touch Social Security, but that's an issue, right? That's a big issue. Insurance companies, right? If we reach a hyperinflation situation, all of the liabilities on insurance company balance sheets can just blow up, and these insurance companies get taken over by the state, and everybody that worked at the insurance company loses their job, and you've got jobs that are lost, and like these products can help solve those potential future problems, which is just really cool. Like they're different cohort of buyer, and it solves an issue. Whereas the convertible bonds were a little bit more of like just need leverage, need capital. Let's hit it with the vol junkies, and yeah, it's just super neat.
Like if you think about it also, the most, and I want to be very careful with what I say here. I know strategy probably doesn't want to directly compete with MSTY and IMIS with a monthly, but I think it would make sense for them to do it because it attracts yet another investor base to this ecosystem that they're building out. And the pitch can be our monthly div may not be as juicy as MSTY or IMIS in certain months, but if you look over the course of time, that dividend they've paid out has wavered, right? But we're going to offer you a set payment every month that you can count on, just like they're going to give you a set payment every quarter that you can count on with Strike and Strife. So the likelihood of this growing in terms of offerings, and I think we talked about this like 3 weeks ago, Jeff, what kind of different offerings they can come up with. I think that is the most common sense one I would do, and I think you have the perfect 4 offering model that they can scale in perpetuity, or perhaps just into next cycle until they see what they're really interested in doing. But I just coming back to my point about simplicity. All people want to know about, they're not us, right? All they're going to want to know about is, okay, how much of a dividend do I get?
Yeah,
for X amount of shares. That's all they care about. That's all the MSTY bros.
Is it going to go away? And is it
Exactly. That's all the MSTY bros care about, right? They say, I didn't buy a house. I bought X amount of MSTY shares, and it's giving me this amount of money every month, and I'm living off of it, right? So if you think about what they're doing with Strife and Stride, if they did it with a fourth offering, call it STRE, stream, income stream, or something, you can easily say to the market, we're going to give you a fixed monthly dividend. It's not going to be as high as MSTY could be potentially certain months, but it's going to be a steady cash flow that you can count on. I think that also goes to the point of these instruments are very easy for the market to understand. Perhaps not Stride, but I think Strike and Strife are. Because I've had a lot of people talking to me, they understand Strike and Strife, but they still don't understand MSTR, they still don't understand mNAV, they still don't understand the leverage ratio, even though that's the simplest part about it. They have a lot of trouble understanding a lot of these different aspects with the common, which is why the preferreds, I think, have been outperforming. You're getting a lot of players in institutional and retail that understand it, and they can put it in a very simple box and say X is going to give me Y, and I think that's part of the massive appeal. So to Dan's point, I think holding Strike and Strife holds massive appeal long term.
I personally think the Strife, Stride are going to have a S-curve adoption, right? Like it's going to be, holy shit. People are going to recognize this. It's just going to take a little bit of time, right? Like education, Dan, it took you 4 months to figure out, like for Strike to just click, and you're like, oh my God, wait, actually, hold on. There's a lot here. How does this work? And, how does it work here?
Well, and I didn't understand the implications of Strife until, a couple months ago.
And that's you who's paying attention to this all day. You don't have a job. You're literally, all you're looking at is all this stuff. And now you've got to go communicate this to people, and Sailor's got to go communicate it to people, and the people that we communicate this to have to go communicate it to people. And it just takes time for that to kind of proliferate in the market. And yeah, it's evolving.
Jeff, do you mind if I bring up this?
It needs to have the surfboard, though.
Oh, gosh. I think it's wicked relevant because, like, when we talk about all this stuff, we're talking about, Strife sitting at the top of the capital stack, and you've got all this Bitcoin being added to the balance sheet. The Bitcoin's growing. So every single instrument in Strategy's capital stack is increasing the collateral factor of Strife. And Strife is limited in its issuance because it needs to be so over collateralized, and the other products have to be over collateralized as well that are junior to it. But as you can see, as the risk-free rate approaches 1 or 0 or any sort of lower number.
Pause, Dan. Go over this. Explain what this is. Explain what people are looking at.
Okay. This is it's a model that prices Strife, again, the crown jewel, the theoretical value of Strife relative to the risk-free rate, which is the 3-month T-bill rate of U.S. Treasuries, and the credit spread. And again, credit spread is just a super fancy word. It seems unapproachable. It just means the risk premium associated with the coupon payments of Strife. So if Strife were risk-free, it would trade at the same coupon payment as the 3-month Treasury bill issued by the United States government. That would be a 0 credit spread. And you can see the limit as both these things approach 0 because it's a perpetuity. So since a perpetuity or a perpetual dividend yielding product, the face value of that product is the integral of all the future coupon payments discounted based on the risk-free rate. So as the risk-free rate approaches 0, the value of that perpetuity approaches infinity. The point being is as the risk-free rate decreases and the risk of Strife decreases, the yield will continue to decrease, which will push the principal up higher and higher. And that's what this little corner represents. So if you believe in Bitcoin and you believe the USD and you pick a risk-free rate in your head long-term, you can kind of model out Strife's price over a long period of time as it goes to the risk-free rate.
Right. Because it's most senior in the capital stack. And you think about what's the probability that a Bitcoin effectively goes to 0, and it's incredibly low. So it should approach a 0% credit spread over time.
Exactly. And if Bitcoin's CAGR is 20, 30%, and they're yielding Bitcoin per share, there will be a point in which Strife, well, it depends how they manage that leverage ratio, but it could be, 100, 200, 300% over collateralized based on by a 20 CAGR asset. And at that point, like, what is the risk on that?
Relative to the U.S. government.
Yeah, relative to the U.S. government, right. And so I don't think it actually trades through the U.S. Exactly. I don't think it trades through the risk-free rate in a scenario that's not predatory towards MSTR. Not the 3-month T-bill rate.
Yeah. I mean, not the 3-month T-bill. Yeah, right. That's fair. Maybe the 10-year, the 30, something like that.
Yeah, exactly.
Right. Yeah, it's an interesting question, interesting equation. There was a comment on here that keeps popping up that I kind of want to address. It's like serious people will always be hesitant of these preferreds as long as they're funded through more of themselves. And I think this is an interesting comment here, and it's not. People like obviously people jump to this Ponzi scheme concept, but what's really happening here is financial strength. This is like what's the word I'm looking for? Like refinancing. Every moment that they raise capital, just you could think of it as like a refinancing. Like they're adding more capital as a function of their capital strength. Just like the same concept of the value of your home goes up and you could go refinance it, go get a mortgage to go redo your bathrooms and your kitchen or something like that. It's a function of your financial strength. And as the value of this underlying Bitcoin asset continues to grow, people are like, they look at the relative risk and the amount of capital that's sitting there, and it's an underwriting equation. Like, do I trust that they can pay this out as a function of underwriting the financial strength of the balance sheet? So it's like a continuous underwriting that's going on. So
yeah, and I think that Ponzi question was that, or what did he say? He said it's like the press.
Yeah, the press, as long as they're funded
for it. If you're worried about
funding
that,
themselves.
yeah, the common pays for it.
Yeah.
But really, it's the Bitcoin.
It's the Bitcoin. It's Bitcoin that pays for it. Bitcoin going up forever.
And the MSTR Common's a layer 3 product on top of Bitcoin.
Right. Yeah, and I mean, and people are also sleeping on the software business, right? Like the software business.
Saying that for a while.
The software business is actually it's pretty cool, right? They've got like an AI for BI that can apply to any AI instrument, so anybody that uses it can hold on to their own data, which is pretty fucking valuable. Like any company that's using an AI platform, any words or anything that your employees are typing into an AI program, that data isn't the companies. That data is the AIs, the AI companies. So Strategy is providing a product that can apply to any of these different AI instruments where they can keep and maintain their data, which is really cool. And I think it's got some legs, and I think the ability to continue to generate significant revenue into the future is pretty significant.
They can definitely scale the BI business and the AI side of the house. That's one of the things I've been talking about for so long, and I'm glad that they're still pushing and they're still trying to innovate there, because I really think that that is going to catch the market off guard if they're able to scale it, even moderately. And they don't need to scale to the level of Microsoft. They just need to scale it 5x in the next decade.
Right. It's funny. Yeah. Oh, go ahead.
No, they just need to scale it 5x in the next decade, and that makes a significant difference in the way this entire thing plays out, in terms of, one, the preferreds, the kind of multiple they can demand from the market, the ability to ratchet up their Bitcoin purchases as Bitcoin's price goes higher. There are a lot of different ways that this can play out with regards to the software business. I'm really glad that they haven't forgotten about it. I think that that should be part and parcel of anything that they do going forward.
Yeah, for anybody that went to Strategy World, or even if you didn't, if you're listening to this right now and you didn't go to Strategy World, about, what did you say, 15% of the people were there for the Bitcoin? About 85% of the people were there for the software?
Yeah.
And like, you walked into the main room and they did presentations on software and all. There were a bunch of employees there that they're like, yeah, I like Bitcoin because the value of my equity package is going up, but I really don't understand what's going on. And they're there for the software side of the business. There were software sales, booths and things there. And there's a big focus on that software side. I mean, it makes up, 95% of their employees. They've got 1,500 employees, and how many 10 are on the capital team?
And as they grow, they can attract more talent. They can attract better talent that can go into the software and BI side.
Reflexive.
Exactly.
Yeah.
So, like, people that are sleeping on the BI side of the business, I think that's a mistake. Because I've been saying for a while, when it comes to data, that's what I do day to day. The need for strong database tools, platforms, and middleware solutions is so extreme that there are guys that I know right now that are juggling 5 and 6 clients at once because of the demand. They do have a moat that they can build out there, and I think it's with small and mid-sized business. They don't need to go after who Microsoft's going after. They're not looking to get strategy software on every laptop in the world. They just need to carve out a niche. Yeah. And they need to scale into that niche, and that can give them 5x from here with the software business.
What's really cool is the product itself is like leaning into the Bitcoin ethos of like decentralized nature of data via AI, which was super cool. So that underlying ethos of Bitcoin is playing out into the software business. Adrian, your point on the reflexivity of hiring talent that cannot be understated, because it's so valuable, right? Everybody in the world is eventually going to want to work for Strategy because the equity package is going to look lucrative, right? The equity, the amount of value. If you're a software guy and you understand what's going on with Bitcoin, you'd be interested in getting a job there, doing anything.
Most of the guys I know that know about Bitcoin do what I do.
Right. What? Just yeah, exactly. Cool. All right. What other topics do we have here?
Well, actually, to answer that person's question directly, I think every entrepreneur looks for areas that have high margins, and then they attack that margin because they're delivering value. So what do we have here? We have people who want fixed income products, and the only thing that they have available to them are the crappy ones that Strategy is absolutely just demolishing with their products. They can't get access to Bitcoin's CAGR, so they're more than happy to get trade their money for a better product than what they have now. So there's a value that's being delivered, And I'm not worried about that market drying up until Bitcoin's market cap is bigger than the bond market. When that happens, like maybe we'll have to figure something else out. But until then, I'm not really worried about the preferreds having to pay for themselves.
Yeah, I agree. It's a massive arbitrage. That's the only way to look at it, in my opinion. Because none of this works if Bitcoin has a negative real growth rate. None of it works. It's all a complete fugazi. It'll go to zero. But if Bitcoin has a real compound annual growth rate indefinitely into the future, it will work. The other really, really interesting point about Strife is the bet they made about these compound annual growth rates. The bet they made with Strife is that until the end of time, the real compound annual growth rate of Bitcoin will be greater than the risk-free rate of the US dollar.
Yeah.
That's the bet they made with Strife until the end of time. If that ever ceases to be true, Strategy will be on its way to insolvency. That is a nuts bet to make. And
It's a one-way bet. It's a one-way bet.
Well, we got the big beautiful bill, and
it's entirely all or nothing. Yeah.
We got the big beautiful bill.
That's the bet
and the cuts don't come in until the next term, right? So which means never. So I don't think there's any risk that we're going to stop printing anytime soon.
No, exactly. But the crazy thing is, like, if Strategy is going to exist in 40 years, the terminal rate of Bitcoin growth still has to be greater than the risk-free rate, because we have no way of wiping Strife off the balance sheet. No way. Zero. Strife will still exist unless they buy it back. And if Strategy were to buy back Strife from the shareholders, its value would go through the roof. And that would be so. There's so many crazy like edge case scenarios there. I think Bitcoin will have a terminal growth rate higher than that of the US risk-free rate. So I think we're good.
All right, guys, I got to drop.
All right, Adrian, final thoughts?
Higher.
All right, man. Take the dog out. Enjoy.
Yeah, and before we move on, I know I was hyping up Strike, but full disclosure, I'm still a full common shares MSTR degen 100%. I haven't moved anything over to Strike. So yeah, still irresponsibly long and all that good shit.
It's so funny. People are like, "Oh, why'd you sell all your MSTR to Strike?" They don't know that I'm in options.
Yeah,
it's like couldn't be more wrong, actually. Yeah, but yeah, it's a weird commentary on the Twitter sphere these days. 100%.
I think Strike at certain prices makes it hard to justify common, but we're starting to get to the point where common's becoming attractive again.
Yeah, and IV is so low on Bitcoin and MSTR. If you think that there's going to be a lot of energy coming into the market in the next 6 months, that equation starts to get a little bit more lucrative and juicy, right? But I mean, you still got $4 billion in MSTY. People are still obsessed with income and not like fully risk on. They think they're going to, take the Misty dividends and reinvest into Misty, and that's going to outperform MSTR. I don't know. I'm a little skeptical on that. Just
the only thing that's going to outperform is like TSLY, maybe.
Yeah, the other one. Yeah, it's just a little bit. It's more inefficient, right? Especially if it's not in a tax advantage account. If it's in a tax advantage account, maybe it makes it more sense if you're in retirement age. But there are less degens in the retirement age, probably looking through that process. I don't know. It seems like a lot of work if you're going to go through that, and if you're going to take the dividend of MSTY and just plow it back into it, it seems like there are better ways to do similar type thing. I don't know.
Yeah, and there's a lot of slippage, right? Like I've run a lot of back tests about selling weekly covered calls, rolling them a certain specific, and I've back tested them out like 3 years, just using the historical options data, because like that's what you got to do. You got to figure out, like, let's say you're selling, but like, for example, let's say you sold an at the money call for a month and MSTR went up. You'd have to sell some of your shares, and now you have less shares. And then you go and sell an at the money call and it goes down. Now you have less shares, you collected that income, but you have less shares to sell at a depressed price again. And that's like the slippage. If MSTR is going up, down, up, down, up, down every month, you slowly lose money. And that's kind of how MSTY works, is you're collecting all this income, but you're sacrificing all this principal stability, and it ultimately decays, especially in a falling IV environment. And IV will decline over the next 5-10 years. So thinking you're going to have a fixed dividend payout while you experience NAV erosion is like, I don't know, it's just suicide.
And a completely different risk profile to any of the preferred instruments. People are like, why would I buy, Strife or Stride when I could buy MSTY? It's like, well, completely different instruments. Like you've got one monetizing the volatility via the derivatives market, and then you have one that's a function of the credit quality of the balance sheet. These are so different.
You're betting on like 3 smelly quants in some office in New York versus Bitcoin as the collateral. I'll take the Bitcoin as collateral and the 3 smelly quants.
That's a good way to put it. Yeah, I mean that's a really good way to put it.
3 smelly quants and a bunch of T-bills on leverage. Yeah, that's balsa wood. That's balsa wood collateral.
But it is.
I don't know.
4 billion.
3 smelly quants. That's a good hedge fund name, or a punk rock band. I don't know. One of the two.
I mean, they're making what, 30 mil a year off that fund.
It's a good deal. It's a good enough deal to keep.
It's a good enough year to underperform MSTR with dividends.
Good work if you can get it.
Think about that. You want a Ponzi scheme? That's a fucking Ponzi scheme.
Yeah. Well, hey, people are buying it. If you've got a shorter horizon.
Yeah, it's not that bad. It's like whatever. I'm just exaggerating. It's like it's cool. You get fat dividends.
You do get
like, I mean, it outperforms during certain time periods, so whatever.
Yeah. It's just interesting.
Just theoretically, it's
well, especially now that the other instruments exist, right? Like you can hold dividend paying stocks with lower risk. I haven't done this yet, and I probably should, but look at like Efficient and Frontier with all of those instruments and try to like model out some assumptions into the future 4 years down the road. And I bet some combination of Strife and Stride, probably Strike and Stride, and MSTR and MSTR calls, you probably wouldn't even you'd probably allocate 0 to MSTY, I would assume, like on the Efficient Frontier. I'm assuming it's like not even on the Efficient Frontier. Like you wouldn't even, it doesn't help.
When you said MSTR calls, you mean long or short?
Long calls. And if you held common, maybe you go short depending on certain situations. I don't know. I think there's 10 million ways to skin this cat. And you can do it efficiently and inefficiently. And if you're going to care that much, you may want to put more effort into doing it yourself. I don't know. That's tough.
Yeah, I think
and there's like leverage, and we don't talk about that because we're not, professional capital allocators or like degenerate hedge funds. But like I think we've talked about it a bit before, guys. But like I don't know, they're at a certain point, especially if you can get cheap enough borrow rates on capital. There was a point in time where levering up Strike 3-1 was like a better, in my opinion, risk-adjusted trade than like MSTR calls in common because of like the downside protection and provisions in the prospectus. So it's like kind of crazy to think like what you can create in a leverage portfolio using these products.
Is that only because, going back to Jeff's chart, we're kind of in that distressed exponential phase? Like at some point, if it levels off, do we lose that advantage? I mean, I guess, is it the early adopters? Exactly. Are they the ones that are getting that advantage?
It's when you're sitting at this kind of floor
down here.
Yeah,
that makes sense.
Ryan's dropping
because at that point, if that's so funny. At that point, if you were to get leverage from your margin account at 8%. And Strike is paying 10, you're like, why wouldn't I lever up as much as humanly possible and buy Strike? Because like I feel like the security of this is great. The upside's fantastic. If anything improves here, like all's gravy, and it's going to cover my my margin cost.
Yeah, that was the crazy arbitrage, was the Interactive Brokers margin rates and the Strife 11% coupon payment for a little bit.
Free money.
Thanks, guys. I'll pick it up. Well, we'll get it.
That's awesome. All right.
And even if you're not paying margin dividends, I mean, the strike drip dividend into more strike is like a perpetual call option, buying, like self-replicating and buying more perpetual call options of itself,
Yeah.
which is a weird.
Which is so cool.
I love your.
It's so cool. And MSTR, because they have the ATMs on all of them, they have the ability to capture that volume coming in the door. So they can send out the dividend. And if everybody's got this like ATM, if everybody's got automatic drip selected for their dividend paying stocks, you've got all this capital coming back in the door, and you're like, oh, cool, great, high volume day. Let me TWAP some ATM in there, bring some of that capital back out, and go buy more Bitcoin with it. It's just a super cool design of all of the instruments. It's fantastic.
Totally agree. So now this is the part of the show where we talk about coins.
Oh, do we get into should we start debating each other about Coincilium and Smarter Web Company and all of these others? I don't know. I do think as you pointed out earlier, Dan, I mean, I think scale is incredibly important here. And like at some point there's going to be so many competitors in the space. If you're not a household name, like it's going to be tricky to continue to outperform. It's like this isn't going to exist forever. Like we are in a very unique point in time where there's a lot of strong, wealthy people, retail investors that are investing in some of these smaller companies and are able to move them quickly with a relatively small amount of capital. But I mean, what happens when somebody like, I don't know, like pretty damn big comes into the market with just a huge amount of capital? I don't know. I'm just throwing out a name, DraftKings, right? DraftKings comes into the space. They adopt a Bitcoin treasury strategy and they hire, I don't know, maybe they go steal Dylan LeClaire from Metaplanet. It's like, okay, well, what happens there, right? You've got real potential competitors that are going to come into the space. There are, despite what a lot of people think, there are a ton of really, really, really smart people out in the world. And if a ton of people are making money, more smart people are going to come into the space, and they're going to find opportunities and make opportunities that don't currently exist. So I think there's a decent amount of risk out in the marketplace for some of those smaller entities. It's just something to be aware of. I'm not saying there's outsized opportunities in some of these, but timing and sizing is just incredibly important. And I'll continue to pound that drum. You've got jurisdiction risk that is unknown. You have known and unknown risk variables, right? You've got your known risk is you've got copycat risk, you've got collateralization risk, you've got operational risk, you've got leverage risk, you've got volatility risk, but you also have these unknown variables, which are I can't say what they are because they're unknown unknowns, and because this space is so new and it hasn't existed before. So I think that there's some more volatility on the horizon in both directions, and just I'd be wary and cautious with sizing, because this is very similar to people, investing in altcoins and losing their stack. And they came in with 100 Bitcoin, they come out the door with 50 Bitcoin, and they could have been better off. They just sat on their hands. So kind of a similar scenario, my opinion.
And I think it's I actually don't think like trading Bitcoin treasuries is like a bad thing at all. Like I think you can get in and get to, like, it's actually for a lot of people it's been very profitable. So I endorse degenerate behavior at times, but you have to be very conscientious of extrapolating forward past regressions of Bitcoin per share acquisition. We talked about this earlier. You can't just look at an exponential Bitcoin yield and assume that will happen forever. And that's what I did. MSTR was hamming ATM in November. I was like, oh, this would just be exponential, whatever. Demand dries up.
Well, let's talk about that a little bit, because I think that's really important too, right? And I don't. Everybody thinks that these trajectories are going to be exactly the same as MSTR. It's the reality is it's not going to happen, and that there are different components here, right? So, and part of this, in my opinion, is a function of the architecture and the design of the stock market, right? Like you've got. MSTR was included in the MSCI Total World Index, but then it was also included in the Russell. It was previously in the Russell 2000, which is only for U.S. companies, The Russell 2000, which is a very large index, is only for US companies. Russell 1000, only US companies. QQQ, which is the NASDAQ 100, is only for NASDAQ listed companies. It's global companies, but you have to be NASDAQ listed. If you're NASDAQ listed, you're subject to different short rules. So people can short your stock more consistently, what's happened to MSTR. And then if you want to be included in SPY, you have to be a US listed stock. So we're talking about like systemically the 5 to 7 largest index funds in the world and mutual funds that are only for US companies, right? So if you're thinking about what are catalysts where you can see a significant amount of capital coming in the door that maybe didn't exist before, well, you have to have these things on the horizon, right? So when I look back and I go look back at November, I look back at March. If I go look back at March of 24, and Ryan will remember this very, very, very vividly, they were included in the MSCI Total World Index and they got revalued in the Russell 2000. And the stock went up from February to March. And I think there was some front running going on and there was capital coming in the door. There's a significant amount of capital that brought the price up to, from $400 up to $2,000 in 40 days. That happened in 40 days. And the same thing happened in November, right? You saw a significant run up in capital. You had $17 billion that they were able to bring in the door and capitalize that and put it on the balance sheet. And I truly believe that this is passive money as a reflection of these index funds and the inclusion in these funds. And that capital comes in waves, and it can only happen if you hit the criteria and meet the criteria. And some of these international companies are not able to be included in some of these funds. So they can be included in other funds, but the size and scale is just drastically different. So if you're thinking that, XYZ company is going to have a situation where they're seeing this huge run up in stock price and get $17 billion in the door like Strategy did in November, it's just probably not going to be the same situation. And it might take a lot longer from a time perspective. And you think about, well, what is the price of Bitcoin when that happens? And how much Bitcoin do they accumulate at that time? It's also going to be a significantly different equation. So, right, and I posted this a couple of days ago. When I first invested in MSTR in the end of 22 and 23, I was thinking to myself, this is the best risk-adjusted trade in the entire market because they have a monopoly on the space. They had 10 times more the amount of Bitcoin than the next closest holder, and the value of that moat at that point in time was like $2.5 billion. Basically, it would have cost $2.5 billion for anybody else to catch them. And now they've actually held that relative moat. So now they have an 11 times moat. They have 11 times more Bitcoin than the next closest company. So the moat is the same, but the size and scale of it's significantly larger in a closed system, right? There's not going to be more than 21 million Bitcoin. So it's okay. Okay, you've got even further here. You've just shoved your moat even higher. Now the cost of that moat is $60 billion in order to buy the same amount of Bitcoin that they would have at today's prices. And that's assuming that doesn't move the price and the price doesn't run away from you. So like who can do that? Like who's going to be able to buy that much Bitcoin to capture them, to capture that value? And I don't see it as realistic. I don't see it happening. And a lot of people have commented, oh, Mag 7 can do it. They can go buy this much Bitcoin and issue prefs and, have this exposure, but it's just not the same, right? Like you're going to have a different proportion of your company that's a function of the valuation of any of those individual equities. So like if Apple were to go convert 100% of their cash balance sheet and then go offer cash balance sheet to Bitcoin and then go offer these preferred instruments, they're not going to move the same. Mm-hmm. They're a $3 trillion company with cash flows and iPhone exposure and technology and AI exposure. It's just going to move differently. It's not that direct correlation to Bitcoin. I mean, they might perform incredibly well. Like I'm sure Apple would do really well if they did this, but it's also been very clear to see that via the Microsoft shareholder vote and the Meta shareholder vote, what Microsoft was 99.5% of people voted against exploring Bitcoin. I think Meta was like 96%, 97%. I think the probability that happens is just so low. There's no incentive to do that. Zero.
Apple returns $112 billion a year to
don't get me started on buybacks. Do we want to talk buybacks? I've been working on buybacks. Are you serious? Buybacks. Check this out. This is cool,
112 billion.
actually. I wasn't planning on sharing this, but let's go over it. Was this?
They make like 140 billion in revenue. Or no, it's 240 in revenue, like 140 in free cash flow, and then 112 billion just shits for
Okay,
shareholders.
I need to pour some more Lagavulin for this.
That's a huge fumble. Like, I can't think of a bigger fumble.
Dude, this is going to be the biggest mistake of all time. Is the share buybacks from
how many
these large companies?
I mean, the shareholders can buy Bitcoin.
How many S&P 500 companies have Bitcoin right now?
2.
Like 2 or 3?
2.
So 498 don't. How long before that number is 0?
Oh, man.
Because based on Tim's freaking marathon, I watched 12 straight hours of Bitcoin treasury companies yesterday, and YouTube, he broke YouTube and it just shut off after 12 hours. So I still got to go back and watch the rest on X. But there's so many companies coming, and some of them are going to be in the S&P 500, and some of these ones that don't adopt Bitcoin are going to be on their way out. I mean, some of the S&P 500 companies will adopt Bitcoin and have a chance to stay, but how many just don't figure it out and are just jettisoned forever?
A lot of them are not going to figure it out. I mean, it's the this is like a Kodak moment, right? Just like not adapting, and they're not going to know until they're already dead, right? A lot of these companies they aren't going to know that they need to do something until they're already dead,
right?
And I think that's just a painful reality. Let's talk through this a little bit, and I still got to work on this, but I was looking back at some of the historical large stock buybacks since 2023. And to your point, Dan, here, 5/125, Apple bought back $100 billion of stock. 4/24/25, Google bought $70 billion of stock back. Microsoft bought $60 billion in September. NVIDIA, $50 billion in August. Apple, the prior year in May, bought $110 billion back. Now, and I know Ryan feels really strongly about this, and maybe we'll bring him on to talk buybacks here at some point soon. But why do you hold an equity? Why would anybody hold an equity? You're holding an equity for some future promise of cash flows, and that can come in multiple different ways. That could come in dividend or share buyback. And a share buyback might be more efficient because of the taxes associated with it. And it allows you to make the moment in time where you sell the stock and then take the tax hit.
I was kind of thinking like an Apple stock. Apple stock is kind of like an MSTR perpetuity.
Yeah. Well, that's why. So because Apple has been so successful and they've emphasized doing these really big buybacks, that's why so many people, like when I worked in my last company, most of the execs in the company, when I talk to them about stocks and stuff, they're like, all I own is Apple. I just treat Apple as my savings account. Like I don't own anything else. And I sat back for a minute, and that really kind of sent me down a rabbit hole. I was like, holy shit. People do that. And they literally, he's like, okay, I own a couple American funds, which are Capital Group, and I own Apple as a savings account because they've got these huge stock buybacks, and it's like, it's not going down. iPhones are everywhere. And right, you look at it and you're like, wow, I mean, they're going to buy back. If they're going to tell me, just the fact that they're telling me that they're going to buy $100 billion of the stock back, you're like, I'm going to front run that. Everybody's front running everybody all the time. I'm going to front run that. That's awesome. I want them to buy the stock back, and they're going to do it. They're going to tell me they're going to do it, and then they're going to actually do it. I'm going to buy it beforehand and just hold on to it, and then they're going to continue to do this. Like, why would I not? That's why it's a $3.5 trillion company.
Can you imagine if MSTR got a yield on their Bitcoin from JP Morgan and then bought back
just stock? Once they start getting LOCs from JP Morgan, old Jamie Dimon, and all those guys, it's very, very possible.
That stock would go through the absolute moon.
Yeah. 30,000 a share.
Sailor said he wasn't going to do that. I mean, Sailor said he wasn't going to do
that.
So
let's just hide most of these just to make it simple. Actually, I'll keep the Chevron one because that one's awesome. But Apple in May, they had $100 billion stock buyback. When they did the stock buyback, the Bitcoin price is 97,000. Let's just say they allocated 25% of that to Bitcoin. So you buy $25 billion worth of Bitcoin, that would have purchased 256,000 Bitcoin. So today's value of that would be $28 billion. So they would have made $3.5 billion in, what is that, 3 months. So the return since they did the buybacks, 14%. The stock price has only moved 1% though. And where'd that go? And so the market cap of the buyback was 3.1 billion or 3.1 trillion, and the market cap today is 3.1 trillion. And the market cap change. And I was trying to, and that the missing piece here that I'm trying to pull together is like, what should the market cap be? You know, what's the as if value of the stock if they would have purchased Bitcoin? That's that missing piece. I'm trying to like back my way into it, around it. But the bigger one here, let's look at Chevron, which is just cool. So Chevron, in January of 2023, they issued a $75 billion stock buyback. So the price of Bitcoin at the time was $23,000. They never would have bought Bitcoin, but it's just fun to, you know, walk through this because this is going to be the narrative of the future. We're after the S&P 500, after that clears, the prefs are going to continue to be really important. And then all eyes are going to be on Mag 7 large stock buybacks. That is where this narrative is going to shift. And it's going to be like, should these companies do stock buybacks or should they buy Bitcoin? And that will be the narrative of like the next 5 years, I think. So you look at Chevron, right? You could have bought $75 billion worth. Even if you would have allocated 25%, you would have bought $18.7 billion capital to Bitcoin. I would have purchased 806,000 Bitcoin. I mean, more than Strategy has, right? just buying 25% of your stock buyback in 23 would have purchased, you know, was that 20-30% more amount of Bitcoin than Strategy, 40-50% more the amount of Bitcoin that Strategy has right now. The value of that Bitcoin today would be $89 billion. The Bitcoin, they would have made $70 billion off that Bitcoin purchased. The market cap at the buyback was $357 billion. So basically, if they would have spent 25% of that buyback on Bitcoin, the value of that Bitcoin, $89 billion, relative to the market cap today, $267 billion, it's almost like a third of the market cap of the value today. So you'd be much better off buying stock in any one of these situations. Basically, the market cap since this buyback has gone down 25%, but the price of Bitcoin's gone up 378%. What, like, Chevron would be trading way higher.
Yeah.
Right? They would be the largest.
You know how we like regret, oh man, I should have bought more Bitcoin when it was 23,000.
Yes.
Imagine these guys in 5 or 10 years when they're looking at your spreadsheet or, you know, doing this math themselves and thinking, man, I could have bought $18 billion worth of Bitcoin at 23,000.
Yes. I mean, make it 100,
What
right?
kind of regret? It just bottomless kegs of beer to erase that regret.
Oh man, right? Like if Chevron would have purchased 100% of that with 100% of that towards Bitcoin, they'd have 3.2 million Bitcoin, and the value of that would be, you know, what is that? Like 40% more than their market cap today. The value of the Bitcoin alone. Yeah, some serious FOMO for sure. But it's an interesting narrative, and you can. I mean, I'm trying to back into how that would impact share price, or just kind of theoretically, right? And I think that's where this is going to go. That, you know, maybe it's not the top 7 companies that start doing this, but maybe it's the smaller companies that do share buybacks. Because I know there's, you know, companies within the top 100 that do share buybacks. They're just much smaller in scale. And the question is going to be, all right, should I do that or should I buy Bitcoin? What's better? What's better for the shareholder? Right? What's better for the shareholder? I don't.
Well, the crazy thing is the shareholders that were presented this at Microsoft and what was the other company said no. Like, I get it that the board is too scared to do it, but when it was put up for a vote and the shareholders voted against their own interest, that's the mind-numbing part. Like, that just makes you realize how early we still are.
Yeah, but wouldn't they argue that they could just buy Bitcoin with the cash dividend?
You let your investors do that?
Yeah, I don't know. I think there is something to that, but
What, with the dividend
Well,
payment?
wouldn't you
then-
rather the stock hold it to increase their power in the market, their financing capabilities?
Absolutely, I think so. But I'm just saying, I think that may be the other argument. That
Yeah.
people make.
Oh,
Well,
the
it's like-
argument that they're having.
Like
Yeah, that makes
I
sense.
could buy Bitcoin myself. Just give me the money back via the stock.
Yeah.
Yeah, exactly. Just return the capital to me. I'll buy my own fucking
Yeah.
Bitcoin.
Well, but like you hold dollars on your balance sheet, like they're going to zero. Like, how, do you want to have strength in the capital markets ever? Do you want to be able to go negotiate? Like when you need a loan, like what's going to be more powerful when you hold a loan, or when you're going to get a loan or recapitalize? I don't know. I mean, right now, in the past, it was definitely dollars. Like you hold more dollars is definitely more powerful. But in the future, does that equation change?
Yeah, I think it's transition, right?
And even if these stock buybacks start to do 5%, right? Like just a negligible amount, 5% of Apple stock buyback, you're still talking about a $5 billion buy, right? Annually from Apple.
Yeah. That's a convertible bond deal.
That's both of Strategy's convertible bond deals in 20 at the end of 24. They did 5 billion in like, I don't know, a month.
Yeah.
That's a ton of Bitcoin being purchased, right? If you take 5% of these stock buybacks in the last 2 years, you're talking $37 billion of buy side volume coming into Bitcoin. Enormous amount of capital. So I don't know. I think that's where this narrative and conversation goes. Like, what's the efficiency? Like, why are companies issuing dividends when they can buy Bitcoin? Because it's much more efficient for your stock. We'll see. All right, we're hour 40 in. What else did I have? Oh, I did some cool calculations here. I think these are fun. So strategy Q2 gain was $14 billion. $14 billion in Q2. There were 62 business days in Q2. The gain per employee is $226,000. They have 1,500 employees. So the gain per employee is $147,000. The gain per day per employee was $147,866. So that's like how much every single employee was technically made from the Bitcoin gain every single day, every single employee. And you compare that to NVIDIA, $8,000 per gain per employee. You compare that to Apple, $2,000 per gain per employee. You compare it to Microsoft, $1,800 per day per employee. And if you're talking about efficiency, I mean, there's nothing more efficient than what strategy is doing here. Like it is the most efficient play in the entire market. And I was trying to think of a way to emphasize like how big $14 billion is, because I don't think people really get it. I've been trying to like emphasize it like over and over and over again. $14 billion is so much money. It's so much money. Like,
was that like your post about the stacking the dollars to the
stacking
moon?
the dollars, right? So I came up with another one that I wanted to share. I think it's helpful. Okay, so just hang with me here for a moment. Imagine $1 million house wherever you live, whatever that looks like. And I know it looks different in everyone's locations, but imagine $1 million house. Now imagine a town with 14,000 people and all of them own $1 million house. 14,000 people, all of them own $1 million house.
Nice neighborhood.
It's an enormous neighborhood. It's a big neighborhood. And all of them are $1 million. That's how much money Strategy made last quarter. That entire town, 14,000 people with $1 million houses. Like, imagine owning all of it. That's how much money they made last quarter. Or like you go into a basketball stadium. Most basketball stadiums hold what, like 20, 25,000 people. So you think of that like 3/4 of the way full, and every single one of them, you own all of their homes at $1 million a piece. You know, it's like, it's just so much money. People can't wrap their head around it. It's just it's just a massive amount of capital in a short period of time. And that scales, right? Like the scales exponentially as Bitcoin continues to rise. Like the base effect math is on the side of Strategy here. Like, we're going to look back on this and we're going to laugh, right? Like 5 years from now, they're going to make $140 billion in a quarter, and we're going to laugh. And we're going to come back to this town analogy and just say, instead of 14,000 people, imagine 140,000 people with $1 million homes and how big that is. Like that's where this is going. And people say, well, it's just Wall Street's going to discount the earnings. No, they're not. I mean, you have to quantify it with some regard. Yeah, it could be volatile, but even if you zoom out and you look at it on a long-term horizon here, like if it drops 50% from here, there's still significant positive position moving forward. It's just crazy. I mean, it's a crazy valuation framework. Everybody's trying to rethink what these things are, what they're worth, and it's tricky. Super tricky. Okay, well, we're hour 50 in. I think it's a good time to wrap. We've got how many people? 9,467 people. Cool. All right. Thanks for the time, everybody. Investment Grade Bitcoin Podcast, episode 32. We got final thoughts. Maybe Dan, kick it over to you. Final thoughts.
I thought it was a really productive episode.
We're diving in. Super psyched to be here. Yeah. Soleil, over to you.
Yeah. So this was another thought I had from watching Tim's Bitcoin Treasury marathon yesterday. There's just so many companies adopting this strategy. And it also goes back to the Bitcoin per yield or the Bitcoin yield comments that we had earlier. The most important decision is the same as for the rest of it. It's just get off zero, because your Bitcoin yield will never be higher than that moment, because the delta is going to be dividing by zero. You used to have 0 Bitcoin. Now you have more Bitcoin divided by 0. So your Bitcoin yield at that moment is infinite. And inevitably, it's going to have to decrease from there. But it's still an important metric. But just getting off zero is the best thing that you can do. And just seeing company after company after company coming on his show doing this, and it's not going to stop. It's only going to keep happening. It just got me super excited.
Yeah, there's so much capital coming to the space. Everybody's seeing opportunity here. Everybody's trying to convert their mom, dad, pop, grandma, brother, sister, uncle, cousin into, adopting a Bitcoin treasury strategy. I had a call with my buddy earlier today. He runs a grass company. I'm like, dude, you need to buy Bitcoin.
Yeah.
And that's just kind of where we're at. And he's seriously considering it. He's like, yeah, we just hired a new accountant. They're young, and I think we're going to do it. And even that is just going from 0 to 1. And then you get started with it, and you keep going. And yeah, that process. And I chatted with another guy, Mavlo, oil and gas guy, traditional guy, works with these slimy oil and gas guys down in Texas and got oil wells and natural gas things. And he's converting profits that he's making on these oil and gas rigs into Bitcoin. And it's a private company. It's like, I have no, intentions of going public or doing anything like that. I'm just in my niche and I'm just running it. I'm buying coin. That's what he calls it. He's like, I'm buying coin. Yeah. And I'm drilling wells and I'm buying coin. There might be up days, there might be down days, but it's all good. And it's just, it's so cool to see. And that's going to keep happening. It is going to keep happening. My final thoughts. There's so much to be positive about right now. I mean, we're getting into a really exciting time here in the second half of the year. Potential interest rates coming down. You've got dollar printing probably on the horizon with the big beautiful bill. It's like a good and bad thing, right? Like you kind of you almost feel bad. Like this is likely going to lead to more inflation, but I think everybody that's here is probably positioned really well. Assets are going to soar, and it's an exciting time to be in Bitcoin. I am just so excited to be working in this space now and keep talking about all these things. And it's all synergistic. Everything helps everything grow. So I've said this before, if you're interested in, growing in this space, start talking about it. Like your X profile is a resume, and everybody that's been on the show, everybody that's been talking about this stuff in the space is building a reputation. And that can, if you want to get a Bitcoin job, like just do it. Like you could just do things. And it's cliche, but you can. And here we are. So appreciate the time, everyone. We will be back next week, and we'll keep this party rolling. Hopefully we get an all-time high and we just start cooking. Everything just starts cooking. That'd be fun.
Hell yeah.
All right. Cheers, guys. Appreciate it.